Hi, my name is Mike Carpenter. I am frequently and sometimes affectionately known as Mike the Money Man. I'm a mortgage broker in the state of Washington, and my license number is 111356. In the last segment, we talked about prepaid interest and how it affects your overall closing costs. In this segment, we're going to talk about debt-to-income ratio. So one of the two most frequent questions I'm asked by my clients is, how much house can I afford, and or can I afford this house? And we'll go through both of those scenarios, and you'll learn how to calculate your own debt-to-income ratio. You don't need an advanced degree in Newtonian physics to figure it out. It's pretty simple. I won't be covering the varying degrees of types of income, like note income or depletion or self-employment income or things of that nature. We're just going to stick with straight W-2 employees. That way we can make it simple for everybody to understand. First, I want to explain, I guess, what debt-to-income ratio is and what the debt-to-income ratio scale is, so you get an idea of what's possible. So debt-to-income ratio and if you remember your grade school math, it just means debt divided by income. So people often ask me, what is a safe debt-to-income ratio? What is an approvable debt-to-income ratio? And that's kind of a relative scale. So let me try to explain that. And I often say that there's two types of borrowers. There's the borrower who wants to afford more than they can actually buy. And then there's the borrower who can afford more than they want to buy. And they seem to be somewhat equally distributed, believe it or not. So a safe debt-to-income ratio is 45%. If I take the debt divided by the income and I get 45%, almost anything on this side of 45% debt-to-income ratio, unless there's some sort of credit challenges, is approvable. And 45% seems to be kind of the threshold of what is doable. Although I've seen debt-to-income ratios get approved at, say, 65%, you may not want to do that. The likelihood that it gets approved really drops off the further on the other side of 45% you go. But we'll talk about how to calculate your debt-to-income ratio or figure out what you can afford further on in the segment. So obviously, in order to determine what your debt-to-income ratio is, you have to figure out what your income is. It's a key component. And as we mentioned, we're only going to be using W-2 income. We're not doing retirement income or dividend income or note income or depleting asset income or any of these sorts of different forms of income. We're just concentrating on W-2 income. So it depends on how often you're paid, but if you're paid an annual salary, all you do is take your annual salary, say $93,600, divided by 12, gets you $7,800 a month gross. And for reasons that are still something of a mystery to me, they allow you to go off of gross income, not net income, or income after your taxes and whatnot. And if you're paid hourly, all you have to do is take your hourly rate times 40 times 52 divided by 12, and that gets you $7,800 a month. The notable exception to that is whether you have some expenses associated with your hourly rate. Some lenders and some loan programs, you have to take out union dues out of the gross income and something called non-reimbursed, not spelled properly, but you get the picture, non-reimbursed expenses. And you have to take out alimony, child support, or something called separate maintenance or spousal maintenance. A quick note on non-reimbursed expenses. So there are some people like police officers or some employees like police officers or firemen or contractors that have to buy their own equipment and then they expense that on their taxes. That typically has to be taken out of the gross income, if that makes sense. But once we've established a gross income, we have to establish debt. And we'll talk about what debt is. Debt is very simple, but it's important to distinguish what a debt is and what a debt is not, because a lot of people think that, say, cable bills or whatnot are debts. So common debts are anything that appears on a credit report. This would be, say, a mortgage. This might be a car loan or a student loan. There are certain specifics associated with, depending upon the loan program, associated with how to calculate the payments of student loans, but we won't go into that. It's too lengthy. So a mortgage, a car loan, student loan, any installments, any installment loans or notes that you pay, and of course the ubiquitous credit card. And we mentioned previously that alimony, child support, and separate maintenance is in fact a debt. So call it child support or alimony. What debts are not, and often people think that these are debts, are things like cable bills or utilities or things like auto insurance or things of that nature. And these are, or open accounts that have zero balance. Anything that's got a zero balance is not considered a debt unless you, of course, utilize it. You know, things like, or say sewer bills or things like that. These are not debts and do not have to be calculated into your debt to income ratio. So after we have established our income, the three parts that we need to calculate debt to income ratio: income, debt, and we'll call it a safe DTI or debt to income ratio of 45%. We can figure out how much a typical borrower can borrow as far as a house is concerned. So let's say that our representative borrower makes $7,800 a month, gross. Again, we can use gross income, not net income. And let's say our representative borrower has a car payment of $300 a month, and say credit card payments of $65 a month. We already know that our debt to income ratio is 45%. That doesn't mean that we can't go higher than 45%. It just means that's sort of a safe number to work with. So we take the income times 0.45, and that gets us 3,510. And that, we've isolated how much debt our representative borrower can handle. And if we take from that, we subtract from that his or her current debt load, these numbers right here, we're subtracting from this figure, we get $3,145 per month, which can go towards what they call PITI, or principal, interest, taxes, insurance. So we have now isolated the maximum he or she can afford for just the house. And if I subtract from that a representative figure for hazard insurance and property taxes, $300 a month, let's say. I don't know where you're going to find a property for $300 a month, but this is just for illustration purposes. Taxes. We now arrive at, we've isolated how much our borrower can borrow for just principal and interest. And that is the principal and interest portion of the payment. Once we've done that, we can extrapolate this out, let's say at 4.5 for a 30-year fixed. 4.5 doesn't represent reality in this universe or any other universe, and it's only for illustration purposes. It doesn't mean that that rate is available. If I extrapolate $2,780 using my magical HP calculator at 4.5 30-year fixed, I arrive at a loan amount, just the loan amount, of $551,624.44. But that's just the loan amount. That doesn't get us the maximum that the borrower can buy. And if we assume that our borrower is putting 20% down, which may or may not represent reality, or your reality, or anybody else's reality, but if we assume that the borrower is putting 20% down, or $137,906.11, which is 1.25% of this number, we get a purchase price of $689,500.55. You can find these HP calculators almost anywhere, and you can find an online calculator. The internet's full of them, so don't feel as if you are limited by your ability to buy a calculator. So in theory, someone who makes $7,800 a month gross and has $365 a month in monthly non-housing debt with a hazard insurance, and this is probably a pretty good number for hazard insurance, and property tax numbers of $300 a month, they can, in theory, buy a property roughly $690,000, assuming that they have the $137,000 put down. What I have not taken into consideration is something that would fit right there called mortgage insurance. So anytime you put less than 20% down, there's mortgage insurance. And that will ultimately affect this number and this number. So if you're putting less than 20% down, all of these numbers will have to be recalculated. But in theory, someone who has this kind of income household income can afford this house. And of course, as we mentioned previously, just because, if you remember our debt to income ratio scale, 45% is a safe number. I've seen debt to income ratios at 55% and say 60%. So just because you have an income of $7,800 a month gross, you're not limited to that number. You could go higher than that number, but as I also previously stated, just because you can do something doesn't mean you necessarily want to do something. So this calculation answers the question, how much can I afford? And I'm often asked, how much can I afford? But I'm often asked in my client meetings, can I afford this? Afford. Can I afford this house? And those are two different questions. Although they sound similar, they're two different questions. In this scenario, how much can I afford? We start with the income and we arrive at a loan amount. But can I afford this house? We start with a purchase price and we arrive at a debt to income ratio. And then we examine whether that debt to income ratio, where it fits on our debt to income ratio scale that we drew previously. So if we take a purchase price of $750 and assume that our borrower is going to put 20% down, or $150,000. Now, not all borrowers are going to have $150,000 put down, but this is sort of a representative example. We arrive at a loan amount of $600,000. Loan amount. This is purchase price, and this is loan amount, and this is down payment. And if we take this loan amount and extrapolate it out for a 30-year fixed at 4.5, just like we had over here, we arrive at principal and interest of $3,040.11 per month. And that is for the principal and interest only. So what we do is we add in our property taxes and our hazard insurance, just like we did over here where we subtracted it. At this point, we're adding it in. $300 a month and $65 a month. Again, I'm not sure if you would be able to find a house with $300 a month property taxes, but this just is for illustration purposes only. We now arrive at principal, interest, taxes, and insurance of $3,405.11. That's principal and interest, taxes, and insurance. And then we have to add back in the debt, our representative debt that we had in our other example, $300 a month for the car, and $65 a month for hazard insurance or homeowners insurance. And we arrive at total debt of $3,000, 77011. And if we take that number and divide it by our income, divide, of $7,800, we arrive at a debt-to-income ratio of 48.334,744 to be exact. Because who, doesn't calculate things out to 6 decimal points? So we examine this debt-to-income ratio against our debt-to-income ratio scale, and we see that it falls somewhere right about here, 48%. So it's slightly above our safe number of 45, but it's somewhat under the period or the place where it begins to drop off and it becomes unapprovable. So this is probably approvable. It really depends upon the borrower's credit profile, and how much in the way of reserves or how much money they've got left over after this whole transaction takes place. But the further you push the edge of approvability, the less likely you are to get the loan approved. So I've put together a handy-dandy debt-to-income ratio calculating spreadsheet in Excel. And if you'd like one, you just email me and I'm happy to send it to you, and you can play with it to your heart's content and calculate your debt-to-income ratio till you're blue in the face. But if you would like one, let me know and I'll send you one. I wanted to address something that I didn't really address in the earlier part of the video, and I wanted to append this video with a little bit more information to help you know how to calculate your debt-to-income ratio properly. So I wanted to talk about something called pay frequency. And this may, this may be very simple, but it's often a sort of a point of confusion. So people are paid one of three ways. One, they're paid bi-weekly, or they're paid semi-monthly, or they're paid monthly. And this is, of course, W-2 employees, not self-employed people. or people, and I'm not going to go into overtime or commission. We're just talking about straight W-2 base income. So in the earlier part of the video, I did a quick calculation where I did $45 an hour times 40 hours a week times 52 weeks divided by 12, and that got us $7,800 a month. Somebody who's paid biweekly gets 26 checks a year, and there's, I think, 2 months out of the year in which they get 3 checks. So biweekly is completely different than semi-monthly. Some people are paid every 2 weeks or twice a month. And these people get 24 checks a year, unlike the people who are paid get 26 checks a year. And there are 2 months out of the year in which the checks are a little bit bigger than normal, but they effectively get a check every twice a month. And then there are people who are paid monthly. And obviously, it's easy to calculate how much your monthly income is. If it's paid monthly, you just take the value of 1 check. But semi-monthly, you have to take the value of 2 checks. And biweekly, you have to use this calculation to figure out what their monthly income is. And again, while this is very simple stuff, I wanted to make sure that you understood how this is calculated so you can calculate your own debt-to-income ratio if you'd like. So, hi, it's Mike again, and I wanted to address a couple of questions I've been getting concerning how to calculate or work in student loan payments into debt-to-income ratio. So oftentimes on a borrower's credit report, student loans are kind of all over the board. Sometimes they're shown with a payment, and sometimes they're shown with a zero balance, and sometimes they're deferred, and sometimes they're reported multiple times. Somebody might get a student loan, and it might be reported 3 times. So student loans are a little bit weird, and it depends on whether or not you're doing an FHA or you're doing a conventional loan. So the rules have changed on how to deal with student loans and how to deal with deferred student loans. Let's say that you've got a $40,000 student loan. I'm just making that up, of course. On an FHA loan, it is the greater of 1% of the outstanding balance or the fully documented payment. And I might also note that the fully documented payment has to amortize. In other words, it can't be just interest only. It has to be, it has to pay off at some point in the future. So let's say that 1% of $40,000 is $400 a month. And the fully documented payment is, say, $380 a month. Of course, I'm just making that up. You would have to use the $400 a month for calculating the debt-to-income ratio based upon on an FHA loan. But on a conventional loan, it is the fully documented payment or whatever appears on the credit report or 1% of the outstanding balance, whichever is less. So just keep in mind that on FHA loans, it's the greater of these two, and on conventional loans, it is the lesser of these two. So depending upon what type of loan you're getting, an FHA loan or a conventional loan, you might be able to qualify for more, or you might be able to qualify for less. Student loans are a little bit bizarre when it comes to calculating the debt-to-income ratio because a number of different factors. Just remember that FHA is the greater and conventional it's the lesser. So I hope that that clarifies things. If you've got any questions, please feel free to email me and I'll be happy to answer them for you. Thanks for watching my video. I hope you found it useful and informative. It's intended as a broad overview of the material so that you may have some further questions. Feel free to ask them and I'll be happy to answer them as best I can. Share, like, and subscribe, but share it with somebody who can actually use it. Maybe someone who's going through the loan process and is a little confused. Hope they get something out of it as well. So happy viewing. There's more to the series. Hope you enjoy the rest of the videos. Thank you. And now for a quick disclaimer. So these videos are intended for informational purposes only. So don't rely on them for making important financial decisions, especially decisions concerning your housing. If you've got any questions about how this information applies to your given situation or your given transaction, please contact your mortgage broker directly and they can give you advice. And any rate, fee, cost, or loan limit information was accurate at the time that the video was made, but may not be currently accurate because underwriting guidelines change all the time. So if you've got any questions about how this information relates to you specifically, contact your mortgage broker. So I hope you continue to enjoy the series. Thanks.